some quick introductions, we'll lay out some facts, and then we'll get right into the panel. So I'm Mihir, Jobalia. I lead the technology practice in investment banking at KPMG, based right here in Silicon Valley. And we'll kind of go around the panel and do some short intros and then get into the facts. Go ahead.
My name is Andrew Scharf. I work for OurCrowd, which is an equity crowdfunding platform based in Jerusalem, offices worldwide. I'm based out of the New York office, and it's great to be here.
I'm Fogelsong. I'm a general partner up at Sandhill Road with Institutional Venture Partners. We have $4 billion of committed capital. We're later stage investors for companies that have already achieved their first 10 million in revenue, anywhere from 10 million to 100 million. We just had our 99th IPO when Jobalia went public.
Caldbeck. I'm the founder and CEO of Circle. We are an equity crowdfunding platform that focuses exclusively on consumer product and retail companies. We won't work with tech companies. We only work with non-tech consumer retail companies.
Hi, I'm Ramneek Gupta. I drive the venture investing efforts at Citi Ventures, which is the strategic venture arm of Citigroup. Since me and my partners took over this effort about 2.5 years back, we've made about 16 investments, and what we're most proud of is the number of commercial deals and pilots that we've been able to achieve on behalf of our companies with various businesses at Citi.
So I think there's been a lot of talk about are we in a boom environment or are we in a bubble environment? And I'll just lay out some quick facts. I think if you take sort of a macro view, the number of IPOs last year was 43 compared to 369 in 1999, so sort of 11% of the volume of 1999. In terms of the proceeds from tech IPOs, we were at $8.5 billion last year compared to $33 billion in 1999. So 25% of the capital raised in 1999. 28% of the companies that went public last year were profitable compared to 14% in 1999. So the companies that are going public are pretty healthy and are profitable. And the median revenues for companies that have gone public in 2013 was 107 million in trailing 12-month revenues compared to 17 million in 1999. So companies are about six and a half times bigger in 2013 than they went public in 99. So sort of all facts kind of lay out where these, it's more of a boom market. Having said that, I think we are living in a market where the valuations are getting frothy. I mean, you're seeing there are 52 companies today that have raised private capital at north of $1 billion valuation. But if you look over the last 10 years, only 45 companies that have been startups have been acquired for north of $1 billion. So we have 52 companies that are valued at north of $1 billion, but only 45 companies that have been acquired for $1 billion over a 10-year period. Castlight went public recently with 13 million in revenues, 13, negative gross margin, and raised $200 million in an IPO, and the valuation on the first day of trading was 3.9 billion with a B. There's a company called Sync Technology. It's a social networking development company. No revenues, no assets, no website, 1 employee. Peak market cap, 6.4 billion. So, I mean, if you look at those facts, it's like, are we back to 99? I don't think we are. But I'll just, take a quick poll here of the panel. Do you guys think we're in a boom or in a bubble? And any sort of examples that you can give which would support your comments? Go ahead.
Well, I mean, from my perspective, which is dealing pretty heavily with the Israeli technology scene, I think we're definitely in a boom period. Bigger companies are coming out of Israel. Israel's always been known for having a lot of smaller companies. But in the first half alone, we've seen deal values total over $1.5 billion, which is on pace to beat all of 2013, which was $2.2 billion. So things in Israel are really rolling despite geopolitical concerns, and there's really no end in sight. So I think, to answer your question here, boom.
I would say these are definitely boom times as well, not yet bubble times, although it is getting frothy. We're seeing more than 2,000 opportunities a year. We make 10 to 12 investments a year, so we have plenty of opportunity. It's a very active period of time, but I wouldn't say it's a bubble.
We have a different view. So I think, first of all, it depends upon what section of the market. If you compare the companies go public today versus probably the frothiest time in modern history, 2000s, it's not a bubble compared to that. For earlier stage businesses, especially in the tech world, Series A, Series B, we do think it's bubble. We look at the companies get funded. We don't see a lot of good companies that struggle to get money from Sand Hill Road. It's a difficult time to find a company that has any value that's not able to raise money very efficiently.
Yeah, I sort of agree with Ryan a little bit. I sort of call it a baboon. It's somewhere in between, I think. And the thought process there is, I think it's getting overheated for certain companies, but at the same time, you actually see these companies going and attacking real businesses outside of just tech. And I think that's the big difference this time around. If you take any of the examples people talk about, WhatsApp, for example, I mean, behind it, it's actually obliterated an SMS industry worldwide. In the US, we don't see very much of it. You take Uber, it's completely changed the way taxis will be hailed in the future, right? So they're actually hitting real businesses and therefore have real revenue. So I think, but at the same time, people's expectations are getting higher and higher with these companies. So it is a little bit heated, but these are real companies as opposed to the last time around.
The one comment I would make is that back in '99, the internet was still evolving in a commercial sense. There's a lot of excitement and hype about it, but today the internet is very well entrenched pretty much globally. And that allows you to build really large businesses today quite quickly if you've got the right idea and the right model.
I think what's also happening is if you look at the amount of capital required today to start a company, it's never been lower. But at the same time, if you look at the amount of capital that's being put into companies to sort of own a market, it's probably never been higher. If you look at the amount of capital being raised by Uber or Airbnb, I think it's kind of staggering. So on one hand, you have sort of an interesting dynamic being on the company side, but also on the venture capital side, you have sort of the industry which is changing. I mean, on one hand, you have early stage funds which are, about managing 6% of the capital. You have late stage funds which are now managing about 66% of the total capital. But the VCs who are in the middle, kind of managing between 100 to 500 million. That number, in terms of number of venture firms as well as the amount of capital, has been cut in half in the last 5 years. And Norm, you've been in the venture business for a long time. How is this kind of dynamic changing how companies are raising money as well as valuations?
I think the comment I would make initially is this business, the venture business, has gotten quite a bit larger over time. Our first fund back in 1980 was a $22 million fund. Our 14th fund that we raised in 2012 was a $1 billion fund. And so part of the capital available helps these companies raise money at a later stage and defer the time at which they might have to go public. You almost have to look at the entire flow of capital, not just private versus public, but all the capital that flows to growth businesses. In terms of the business and early stage and seed funding, we're glad to see crowdfunding and seed funding. It's just more than that better because there's more potential candidates for us down the road. At the same time, with the scale that we have, I think we could play in a place where venture couldn't play before.
Ryan, the other part which is kind of changing is you're seeing crowdfunding is going to set to raise sort of close to $7 billion over the next year, and you have over 1,000 organizations which are raising money. And so, how active is the market? Kind of give us a perspective on what you're seeing on the crowdfunding side.
Well, that's a great question. The market right now is simply put on fire. OurCrowd was launched about 16 months ago, and we've already deployed over $60 million of capital into approximately 40 companies. We see 300 deals inbound, unsolicited to us a month, and we have a pretty serious deal flow team to process that. We think it's great. We think that the crowd that we have behind us, which is 5,000 plus accredited investors, adds value to every single transaction that we do. And we're very excited about the opportunities that are coming to us, that we're brought into by terrific venture partners, venture capital firms that we have. So we think that crowdfunding is definitely here to stay. It is definitely on the rise, and the market is terrific.
Yeah, From our perspective, there's still a lot of heat around the industry and candidly a lot of noise. I think that there are a few platforms like OurCrowd that we really respect a lot. There's also literally hundreds. There's also literally hundreds of platforms out there that I think are struggling to find their way, struggling to find a business model that is kind of economically viable long term, but also is helping either side of the market. And I think it'll take a couple years before that plays out. In the interim, we fully expect there to be some disasters. I think there will be some platforms that raise money and break existing regulations, whether those are SEC or FINRA regulations. I think that there are some investors that will lose some meaningful money, especially in the equity platforms. And the equity platforms where you've got folks that are running it that have never worked in finance or investing. So I think we've got a competitor out there that most folks here would never have heard of that publicly says, well, our founders never worked in finance, and I'm very proud of that. And it's hard for me to understand why you'd want to go to a doctor that never went to medical school, or get your car fixed by a mechanic that has no engineering background. If you're using a platform that's designed by someone who has no experience investing, it shows through in a number of different ways. This is a heavily regulated industry, and we think the platforms will survive. Platforms are actually going to help both sides or have that background. We see that with OurCrowd, we see that with a few other platforms, but before this is a mature industry, there are going to be some speed bumps and some people are going to lose money along the way.
Can I just add to that? I mean, Ryan, you're absolutely right. And there are so many crowdfunding platforms out there because I think it's sort of the en vogue sort of area in venture finance these days. But as Ryan said, the cream will definitely rise to the top, and those are platforms led by seasoned, experienced entrepreneurs and venture capitalists like Ryan, my boss, John Medved, that do put tremendous amounts of due diligence into their teams, into the companies that they invest in, and into their own investors. And it's something that we have to constantly stay abreast of as crowdfunding leaders. Ryan and I, these new regulations, and to ensure the integrity of the industry. And I think that's the most important thing.
I would say also that the venture business takes hard work. From the outside, it looks like this is easy business, but this is not an easy business. You really have to work hard at it. And I think a lot of people who are doing a lot of seed funding will discover you've got to make a follow-on investment, you've got to work with the management team. It's a little more than just writing that first check.
Yeah, quickly, I think there's a lot of folks that are predicting that crowdfunding will disrupt all parts of finance at all stages in all industries. And I completely disagree. For example, and I'm not saying this because you're sitting here, I don't think there's any chance that a crowdfunding platform, in the next 20 years disrupts IDP. I mean, the types of businesses that they're working well, but it's also it's a very competitive, more candidly efficient market. Like there's a lot less value that a platform like ours can add. We'll contrast that with early stage food companies with $3 million in revenue. There is no existing source of capital for those types of businesses. It's much easier for us to create value for those entrepreneurs and for investors that want to connect with them because there aren't other choices. I think a platform that is going to be able to add more value than IVP with X billion dollars behind it, I think it's tough for me to believe.
Yeah, I think also the mortality rate for companies is pretty high for early stage companies, and I think even if you look back in Silicon Valley, the venture capitalists and even the individuals who have funded early stage companies which have become $1 billion plus companies, it's a pretty small group. I mean, it's hard business. I would agree with sort of the comment that you made. Let's switch gears for a second. I think there's a lot of interest in sort of consumer internet. I mean, you're seeing for the last 5 years, we're seeing everybody in this room has a smartphone. People around the world. I mean, you see the growth of mobile, the amount of location-based data and what you can do with that data is kind of just growing exponentially. Having said that, I mean, you're seeing a number of sort of B2C companies or consumer companies getting valued at north of $1 billion, and at the same time, there have only been sort of 15 consumer exits, consumer B2C tech exits, which have been north of $1 billion over the last 10-year period. So how do you reconcile the exuberance in sort of B2C companies when you have valuations like WhatsApp and Uber with companies that you're looking at? I mean, has the valuation, has the expectations just gone up dramatically in the last year?
Yeah, I think that's a very, very good point. And there are a few things that I would just sort of add as things to think about. One is, I think last 10 versus last 5 is a big difference in terms of years. 5 years from now, iPhone had just hit, 7 years I think is when iPhone had just come on the scene, and about 5 years back is when it really sort of proliferated, right? And so the first 5 years were very much 99 type technology stacks and the way you did business then versus, so that's one factor. The second is, which we just talked about, how these, because of the emergence of mobile, constant connectivity, etc., things are, it's no longer tech companies serving tech companies. It's tech companies taking over real physical markets that need innovation, could not get that in the past, but are now being attacked by real solutions. So if you look at the companies that are sort of being valued at those sort of numbers, it's very much around, I think of them as very long runways ahead of them. So where we are starting to get a little bit sort of uncomfortable when it comes to valuations is people are starting to give a lot of that value upfront to these companies, then wait for them to take over. But I think there is a strong belief that these are the leaders in their spaces. So I feel like a few of those things, if we sort of take into account, it may or may not feel as stark as when you say, all the 15 companies with $1 billion valuation happened, in the last few years, kind of thing. So I think there are a few other things if you look into the nuances, it might be less stark than that.
So just to add to that, I think we want to be clear that an M&A transaction is an exit, but an IPO transaction is not an exit. For most companies, an IPO is just a financing event, and it's all about building the company downstream, whether it's $500 million now or $100 million or $1 billion or more. You have to look at what these companies' valuations could grow into several years after the IPO, which is why I think we're seeing some very high valuations. Some of them are very high, but today, if you look at what's going on, given the size of the markets that these companies are addressing, the size of the markets that they're creating, I think it makes a little more sense.
I think what's also happened is that I think the number of technologies now being in the hands of the consumer, you are now being able to completely disrupt a number of sort of existing businesses, like, taxi business is one, but I think even something like an Airbnb, where it's a network effect business, and it's a winner-take-all kind of market where it's completely disrupting travel. The other part, which is very interesting, is if you look at the $1 billion club, there are 52 sort of tech companies now, private companies, which are being valued at north of $1 billion. If you've had a decent IPO market, companies that have gone public have done well. We've all seen kind of windows open and shut, but if the IPO market goes away, what happens to some of these companies that have raised north of $1 billion? And how does that factor into kind of deals that you're funding, whether it's any of you?
So you're talking about companies that have raised more than $1 billion?
Or
at $1 billion?
At $1 billion plus valuation, the number of buyers for those companies starts becoming very small.
So I think there's two things that happen. One, you either do a subsequent round of financing, perhaps a lower valuation, or else you just spend less and moderate your growth rates to get to break even until you have another financing.
Yeah, totally agree. And I think the amount of capital most of these companies have today, fortunately, some of them have that actually in the back of their mind when they're raising such large rounds, because they're saying, let's have enough capital on our balance sheet to live through any such, at least once, downturn in the cycle. And I feel like that might help some of these leaders as well. I don't think there'll be capital constraint if there is downturn. But again, it's whenever there are a few $1 billion, it sort of seeps through, and there'll be a lot others who look like them but are not going to be leaders like them. And so I think there'll be some pain, but the leaders will go through it.
One of the key questions which we ask when we're looking at large rounds of financing is management's philosophy about maintaining a minimum cash balance.
Yeah.
If we're going to raise $200 million, are you going to keep $50 million? Are you going to keep 10? What's your thought about the minimum amount that you're going to raise? And then look at that against the growth rate.
For us, the most common exit for an angel in the consumer product retail space is an M&A transaction. So if you look at the Kaufman Foundation, which looked at angel returns by industry in the consumer and retail space, the average return is about 3.5 times your money in 4.5 years, but by far the average exit, the most common exit, was M&A. That's how Nestle, Coke, et cetera, that's how they grow. They don't innovate from within as much, they buy companies. It's twice the size as the M&A market in tech. So for us, there's a good chance we will never have an IPO, but the investors can still be very successful through M&A.
Which is not unusual, because I think for most, even venture, if you look back at venture-backed companies in Silicon Valley, or broadly in the US, 95+% of the exits are through M&A. The IPO is generally a financing, not a liquidity event for investors or employees. We have a few minutes, so let's ask sort of the last question. If you think about companies in this market where, talk about one company sort of within that you've looked at where the valuation is high but it's justifiable, but and why do you believe that? And secondly, give one example of where you've seen a company where the valuation is high and absolutely not justifiable, just to create something provocative. So Ramneek, we'll start with you and kind of go down the path.
Sure. I'll take the easy one because I got the chance to start first. We all sort of believe in some of these companies, but to me, Airbnb is an example where, and I'll give this from a personal example perspective. I think I was the first employee at Citigroup 2.5 years back to use Airbnb for corporate travel, and I had to go through all sorts of exceptions to get it sort of paid through our system. And just 2 days back, I think I saw that they've now struck a partnership with Concur, which is one of the sort of the travel providers at Citi. So I think over time it'll find its way. And I think that's the point I was trying to make earlier, which is these are companies that are going after real markets, which traditionally would not have been attacked by some of these platforms in the past. So you start out thinking of them as, rent out my couch and my little sort of one-bedroom apartment to some random person. Two, they could be viable, better corporate travel solutions, they could be viable, better holiday travel solutions, etc. And then you start to see, I think people who saw that early were the ones who gotten at valuations that were a little bit uncomfortable and unjustifiable at that time, but at least are starting to see their companies grow that much. So to me, that's an example. On the one that I'm not comfortable with, I'll just take the easy one, Sync Technologies that you just mentioned. I have no idea how that even happened